In February 2025, reports that Warren Buffett's Berkshire Hathaway had made a significant purchase of Domino's Pizza, ticker DPZ. Stock became a major topic among investors. Following this news, many investors have followed suit. But why are so many prominent investors and institutional investors paying close attention to Domino's Pizza stock? The reasons behind this include the company's solid performance, industry trends, and overall market sentiment. Hello. In this video, we'll be discussing why Warren Buffett sold S&P 500 and purchased approximately $83.32 billion worth of Domino's Pizza stock. If you find this video interesting, don't forget to like and subscribe to the channel. Domino's Pizza's strong performance. The strong performance of Domino's Pizza DPZ can be attributed to improved profitability, aggressive share buybacks, and a shift in its growth strategy. In particular, the steady growth of EPS, earnings per share, and the long-term enhancement of shareholder value have been key factors in the decision of prominent investors to make significant purchases. Improved profitability and cost management. Domino's Pizza reported an EPS of $4.19, approximately $638 in Q3 2024, marking an increase compared to the same period the previous year. This growth was achieved despite rising raw material costs and an increasingly competitive market environment, thanks to the company's optimized pricing strategy and cost management. In particular, investments in technology and enhancements in digital ordering have streamlined operations, leading to improved profit margins. Furthermore, the company recorded a gross profit margin of 39.05%, the highest level in the past decade, surpassing its competitors. Amid intensifying competition, its low-cost supply chain strategy and unique franchise model have contributed significantly to its revenue growth. Aggressive share buybacks and shareholder returns. Over the past year, Domino's Pizza has conducted a share buyback equivalent to 1.00% of its outstanding shares, with an average buyback rate of 5.00% over the past decade, demonstrating a strong commitment to shareholder returns. This reduction in the number of outstanding shares has led to an increase in EPS, thereby enhancing returns for shareholders. Additionally, despite the increasingly competitive market environment, the company has maintained its dividend policy while continuing share buybacks. This strategy has made it an attractive and stable investment, drawing significant attention from institutional investors. Shift in growth strategy and market share expansion. From 2024 to 2025, Domino's Pizza has been expanding its digital platform and implementing AI-driven delivery systems. These advancements optimize order processing, reduce delivery times, and lower labor costs, enhancing the company's competitiveness. Additionally, Domino's has strengthened its menu offerings to appeal to price-conscious consumers, leading to significant sales growth, particularly in the US and Australian markets. The company's revenue is projected to reach $5.036 billion, approximately $767.1 billion, in 2025 and grow further to $5.387 billion, approximately 826.1 billion yen in 2026. By combining steady profit growth, shareholder return initiatives, and efficient management strategies, Domino's Pizza has attracted the interest of prominent investors. As digital transformation progresses and cost optimization continues, further growth is expected, making it likely that institutional investors will continue increasing their holdings. Industry trends and Domino's Pizza's strategy. Domino's Pizza is enhancing its competitiveness by leveraging digital platforms and strengthening its delivery services. This strategy accurately reflects the overall changes in the fast food industry and shifts in consumer behavior, particularly excelling in both digital ordering and cost reduction. Utilization of digital platforms. As of 2024, approximately 75% of all Domino's Pizza orders are placed digitally, with the company leveraging AI and machine learning to optimize order processing. In particular, the introduction of the voice recognition AI DOM has improved customer service efficiency while successfully reducing labor costs. Furthermore, enhancements to the mobile app have optimized the time from order placement to delivery, leading to increased customer satisfaction. Strengthening of delivery services. Unlike competitors such as Uber Eats and DoorDash, Domino's Pizza maintains its own delivery network, which serves as a major competitive advantage. This allows the company to minimize delivery costs while maintaining strong price competitiveness. Additionally, in 2024, Domino's introduced the new Pickup on the Go service, enhancing the convenience of pre-ordering and in-store pickup. By enabling customers to pick up their orders themselves, the company has further reduced delivery costs. Optimization of promotion frequency. In 2024, Domino's Pizza achieved sales growth without increasing the frequency of promotions. This was the result of focusing on enhancing brand value and strengthening customer loyalty, rather than relying solely on discount strategies. In particular, the company reinforced its subscription-based rewards program, increasing the proportion of repeat customers and ensuring stable revenue. cost reduction and franchise support. In 2024, Domino's Pizza successfully implemented a $5 million, approximately 761.65 million yen cost reduction program. This initiative supported increased profitability for franchise partners and enhanced the sustainability of store expansion. Additionally, the company improved operational efficiency through bulk procurement of raw materials and the automation of kitchen operations. Domino's Pizza's strategy is built around four key pillars: digitalization, strengthened delivery services, cost reduction, and optimized promotions. These elements have been instrumental in driving growth in the highly competitive fast food industry. Moving forward, the company is expected to continue its sustainable growth by adapting flexibly to evolving consumer needs, market sentiment, and investor trends. Warren Buffett's Berkshire Hathaway's acquisition of Domino's Pizza DPZ stock has had a significant impact on market sentiment. In particular, Buffett's investment approach is rooted in long-term value investing, sending a strong signal to the market that Domino's Pizza is a high-quality company with the potential for sustainable profit growth. Buffett's investment criteria and Domino's Pizza's alignment. Buffett's investment criteria generally emphasize the following factors: stable cash flow, sustainable competitive advantage, wide moat, predictable profit growth, strong shareholder returns. Domino's Pizza secures stable revenue by leveraging its strong brand power and delivery-focused business model. In particular, the company's expanding revenue and improving profit margins driven by its digital strategy align well with Buffett's investment philosophy. Market impact and institutional investors following suit. Buffett's investments serve as a stamp of trust for many investors. Historically, stocks chosen by Buffett have garnered significant market attention, often experiencing short-term price increases. This time was no exception, as Domino's Pizza's stock price rose 6.9% in after-hours trading. Institutional investors, including SquarePoint Ops, Millennium Management, and Renaissance Technologies, also responded to this movement by increasing their holdings in Domino's Pizza. This created the Buffett effect in the market, leading to an inflow of more capital into the company. Consumer psychology and the impact of pricing strategy. Amid increasing global economic uncertainty, consumers are becoming more price conscious. Domino's Pizza has capitalized on this consumer mindset by offering high-quality pizzas at an affordable price point, rather than positioning itself as a high-end restaurant. In the highly competitive fast food market, Domino's stands out by utilizing its own delivery network instead of relying on third-party delivery services like Uber Eats and DoorDash. This approach helps keep costs low, contributing to revenue stability. This sustainable business model has led investors to view Domino's as a recession-resistant stock, driving further buying interest. Buffett's acquisition of Domino's Pizza stock has significantly influenced market sentiment, prompting many institutional investors to follow suit. Additionally, the company's pricing strategy, which aligns with shifting consumer psychology, and its digital-driven profit margin improvements support its long-term growth potential. These factors combined suggest that Domino's Pizza will likely remain a highly attractive investment in the market. Economic background and future outlook. As of 2025, the global economy faces increasing uncertainty due to persistent high inflation, rising geopolitical risks, and growing consumer frugality. In this environment, several key factors explain why Domino's Pizza has attracted the attention of institutional investors and become a target for large-scale purchases. Consumer behavior focused on cost performance. Consumer purchasing behavior is shifting toward prioritizing value for money. Across the restaurant industry, while high-end restaurants and full-service dining establishments are experiencing declining sales, chain restaurants offering affordable meals are demonstrating stable revenue trends. In this market environment, Domino's Pizza maintains its competitive edge by offering high-quality pizzas at a mid-range price point while leveraging its strengths in the delivery market. Cost reduction and service enhancement through digitalization. Since 2024, Domino's Pizza has been advancing digital ordering and AI-driven delivery optimization. These initiatives have improved store operations efficiency and reduced delivery costs. In particular, measures such as automated order management, optimized delivery routes, and experimental implementation of robotic delivery have contributed to increased profit margins. Revenue stability and franchise model. Domino's Pizza's revenue model relies on franchise expansion, allowing the company to minimize direct risk while securing stable royalty income. As a result, economic fluctuations have a relatively smaller impact on its performance, making it an attractive stock for institutional investors due to its strong recession resilience. Long-term growth strategy and market expansion. Domino's Pizza is focused on future growth by expanding into emerging markets and strengthening its delivery infrastructure in existing markets. In particular, store expansion in the Asian market and increased sales efforts in Australia are expected to drive revenue growth beyond 2025. Amid economic uncertainty, Domino's Pizza continues to secure stable demand in the affordable dining sector, while maintaining profitability through digitalization and efficient management. This has led institutional investors to view it as a resilient stock even during economic downturns, resulting in large-scale purchases. Domino's Pizza's latest performance and market trends. In its Q3 2024 earnings report, Domino's Pizza DPZ reported a 5.1% year-over-year increase in revenue, with earnings per share (EPS) exceeding market expectations. However, domestic same-store sales grew by only 3%, falling short of expectations, while international sales saw a modest increase of just 0.8%. This is likely due to intensified price competition in the fast food industry and the growing consumer preference for cost-saving measures. Price competition and changing consumer behavior. In the fast food industry, competitors such as McDonald's and Burger King are offering low-priced set menus, intensifying price competition. Amid rising inflation, consumers are becoming more cost-conscious, increasing demand for affordable and high-value meals. To adapt to this market environment, Domino's Pizza has been optimizing its coupon strategies and promotions. However, the intense competitive landscape appears to be a contributing factor to the stagnation in same-store sales growth. Regional performance and growth strategy. In the Australian and New Zealand markets, increased demand for lunch, snacks, and late-night orders drove a 10.4% revenue increase, achieving record high performance. However, sales declined in key markets such as Japan, Malaysia, Germany, and France, with same-store sales down 1.3% at the beginning of fiscal year 2025, highlighting ongoing challenges. As a result, Domino's Pizza has decided to reduce its planned number of new international store openings from the initially projected from 825 to 925 locations to from 800 to 850. This adjustment reflects a strategic shift aimed at balancing growth with risk diversification, cost reduction and franchise strengthening. Domino's Pizza has implemented a $5 million, approximately 761.65 million yen cost reduction program, reinvesting these savings into store operations and improving franchise partner profitability. Through this strategy, the company aims to enhance operational efficiency and achieve sustainable growth in a highly competitive market. Institutional investors' evaluation and future outlook. Considering these initiatives as a whole, many institutional investors have made large-scale purchases of Domino's Pizza stock. In particular, the company's long-term growth potential, strong brand presence, and improved profitability through its digital strategy have been key factors attracting investors. Going forward, strengthened cost management, effective responses to price competition, and the expansion of delivery services will be crucial for further growth.